All right, let's get some insights on the news that's shaping markets. For that, we want to welcome in Eddie Ghabour, owner and key advisors, Wealth Management. Eddie, it is good to see you. I'm so glad you're spending a little bit of your Friday with us. All right, let's talk about the market setup right now. It looks like the bulls still have the reins, and it's kind of this steady step forward. You call this one of the best market setups in 30 years. What's driving your conviction?
So the conviction, number one, is there's still so many people that continue to doubt this rally that hasn't participated in it. It's one of the most hated bull runs that I've seen off the V-shaped recovery we've had. But when you take a look at the next 12 months, which is what we're looking at right now, and you have a massive amount of liquidity that's going to be hitting the marketplace at a time when you're in a non-recessionary environment. Many times when you have this type of liquidity boom into a system, it's because the economy is in a recession and they need to do something to stimulate it. Well, we don't need that because the economy is continuing to be resilient, yet you're going to have the entire globe over the next 12 months loosening monetary policy. Here in the U.S., our Fed's going to be cutting rates over the next 12 months. We've got the tax cuts and some deregulation that has not hit the tape yet that will filter into the economy. So we think going into the fourth quarter, the softening that we have seen in the economy is going to reverse and start to reaccelerate. So we think this economy could really boom starting in the fourth quarter going into next year at a time when there's still a tremendous amount of cash on the sidelines. So we think the surprise to the market will be to the upside, not to the downside over the next 12 months.
Okay, so what are the skeptics getting wrong then, Eddie?
Well, I think the only argument they have right now is the market's overbought. But markets can stay overbought for a long period of time. The other argument that I think they're missing is a recession. They continue to call for a recession, the bears, that is, and the labor market just continues to prove them wrong. The consumer is continuing to stay resilient. Has there been some softening? Absolutely. Housing, one of them, but we think housing has bottomed. So we think the trend is going to be interest rates down over the next 12 months, which will help housing and get the economy reaccelerated. So until there's a recession or labor market starts to really crack, this bull market has a lot of legs.
Okay, so we are a week away from that August 1st deadline, Eddie. Do you have any concerns about that, about there not being, say, enough deals that come to the table by August 1st on the trade front?
I think one thing that hopefully has been proven now since the bottom is the word tariff is just a headline risk that's been nothing but a buying opportunity. So these concerns with trade deals and tariffs has been a bull's best friend because it's been buying opportunities. At the end of the day, as we've really dissected this, these tariffs affect a very small percentage of our overall economy today because we are a service-driven economy. So we think this is a non-issue. If there's any volatility that comes because of it next week or the week after, we will be aggressive buyers because at the end of the day, in the next 3 to 4 months, these trade deals will be and tariffs will be in the rearview mirror, and we'll be focusing on our growth trajectory heading into 2026.
Okay, that's fair. So heading into 2026, since you see essentially double-digit upside over the next 12 months, walk us through where you see opportunities in sectors. I know you've got a couple of names on your list, but I'm curious about sectors.
So what we've started to see now, which again is another case for the bulls, is the market is really starting to broaden out. So we've been so heavily weighted in tech because it's been one of the very few areas of strength. But over the last several weeks, we have started to rotate into financials, have gotten strong. Materials have gotten strong. Housing, we just bought housing yesterday, ETF in that area because we think that has bottomed. And then small caps have been one of the most hated areas to be in. And if we're right on the economy and interest rates over the next 12 months, investors can be more diversified and broaden out into those areas. So that way they're not so heavily weighted in technology, which has been the only game in town essentially for the most part.
So when you speak about small caps, you're talking about IWM as the ETF that is at a minimum on your watch list or that you just recently bought into.
Yes, the IWM, we bought that a few weeks ago. I think it's up a little bit, not much yet, but we're small caps. We may have a little air pocket here during the weak seasonality of August, September. And if we do, we will double our position there in small caps because we have a strong conviction on the fourth quarter. So we think small caps will break the 2021 highs in 2026.
What's the for housing? You say you just got into housing because you see a bottom there. One, what gives you that conviction? Two, is it? I'm assuming it's an ETF. What is the ticker?
XHB is the ETF that we bought yesterday. This has housing. It also has some materials in there, which we like because of the infrastructure build out. It's going to have to be on data centers and housing. But the reason for the conviction is it is a contrarian play. It's been a very bad place to be for the last 12 to 18 months. But we believe that we have seen the high in mortgage rates. We think starting at the end of this year, going into 2026, you will see mortgage rates come down. So again, you may see a short-term spike again in August, September, but the trend after that is going to be down. So we're going to want to continue to buy dips there. And if we're wrong, we'll pivot out. But the accelerating economy with lower mortgage rates should form that bottom that we think has already happened for housing.
Okay, I mean, look, it is slightly higher year to date, so there is some potential there. To your point, we'll see if that thesis proves true as we look out over the next through the balance of the year and into next year. Let's talk a little bit about another name on your list you've got, and this is in the tech sector, Amazon. It's been an underperformer within the Mag 7, but you see a potential breakout. What drives that?
So we believe this has been unfairly punished because of tariffs. You know, if you take a look at Amazon, I think it started to get treated like a retail stock due to the tariff concerns. And we're starting to see, from a technical standpoint, this stock really catching momentum. So it's a contrarian play that we think is going to start to catch up to the Mag 7, but also a fundamental story. I mean, they are an AI play in this space. And so the robotics that they're looking to create efficiencies in their warehouses should be great for them. AWS continues to be an area they're investing in. And again, because we think the tariff headline risk will be in the rearview mirror in the next 2 to 3 months, we think this stock is already starting to foresee that, which is why it's catching a bid. So we're in that name, and we hope that we get an opportunity to buy more.
And Eddie, I want to get your final thought on this. For the cash that's sitting on the sidelines, let's say scared cash, what do you say in terms of deploying a capital?
So, you know, for us, we don't have a high cash position, but the reason why we think these dips will be shallow is because these folks that are sitting on a tremendous amount of cash have really underperformed. So they're going to be forced to performance chase here in the back half of the year. So a 3% pullback right now will probably feel like a 10% pullback with how strong this market's been. And so we think there'll be natural buyers because of these funds that have been sitting on a lot of cash. You know, in other areas that you could look at to diversify is, you know, don't forget about the metals. I mean, gold has been a great place to be this year, and dips should be bought there as well, too. So we think there's a natural demand that will be buying these shallow dips that we will see possibly here in the next couple of months.
All right, Eddie, we will leave our conversation there for today. That's Eddie Ghabour, owner, Key Advisors Wealth Management. Thank you, Eddie. Have a great weekend.